Gold prices hit a record high,
up nearly 30% so far this year, torching stocks and bonds.
You could call it a modern-day gold rush.
This move higher in gold has been building for quite a long time.
Above $3,000 per ounce.
And arguably plenty more to go.
The look of it, the taste of it, the smell of it, the texture.
So gold recently hit $3,300 an ounce, a new all-time high, and that really says things. To put things into perspective, 10 years ago, the gold spot price was hovering around $1,100. That's a 200% rise in a single decade. But what's even more remarkable is that in the past 3 years, gold has soared by nearly 90%. And this is during a time when stock markets were surging, interest rates were rising, and inflation was supposedly back under control. So what's going on? In this video, we're going to dive into why gold is so astronomically high right now, and more importantly, what that rise is really telling us. Because when gold moves this fast and this far, it's not just about investor demand, it's very often an economic warning sign. There are really 4 key points to talk about here, and I want to give a shout out to investing.com for helping me out with this video, particularly their Investing Pro subscription. I found this to be a really intuitive way to track my watch list. As you can see, they have fair value estimates all on the one page, and I can even add my own price targets, which is really cool if you're tracking margin of safety levels like I do. Warren AI is also another really cool feature, which I've been asking lots of questions, particularly for this video. As you can see, Warren AI told me that gold is now trading above $3,300 per ounce, with reasons for its big rise including fading dollar strength and geopolitical jitters to institutional stockpiling and shifts in physical demand. There's honestly a lot to dive into in the Investing Pro subscription. I also really like the Ideas tab, where you can look up famous investors like Buffett, Gates, or Dalio, or even explore investing themes like founder-led companies, for instance. This is really just scratching the surface, so if you do want to jump on board and try it for yourself, they're having a massive 50% off sale at the moment, but if you use my link in the description and pinned comment, you'll also get a further 15% discount. So it's a great time to get in. If that's of interest, please check out my links in the description and pinned comment to learn more, and use the code NEWMONEY at checkout, and thanks to investing.com for sponsoring this video. But going back to gold, and as I was saying before, there are really 4 key points to talk about as to why the price is so high at the current time. Now, the first and most common reason that people are bidding up the price of gold at the current time is because there is a lot of genuine fear out there around fiat debasement, or put more simply, the slow erosion of your money's value over time. Since the onset of COVID in 2020, the US dollar has now lost over 20% of its purchasing power. Now, that's not just a rounding error, that's 1/5 of your money quietly evaporated in just 5 years. You probably felt it too. Groceries cost more, rent jumped, interest rates spiked, but the money in your bank account doesn't stretch like it used to. After a long period of minimal inflation, over the past 5 years, inflation has roared, and it's eroded a lot of wealth that's been grounded in US dollars. Now, let's compare that to gold. Over that same period, the gold price has climbed by more than 100%, with a nearly 90% jump in just the last 3 years. So while cash lost value, gold gained value. And that's exactly why people like to turn to it in times like these. It's not necessarily about speculation, it's about preservation of wealth. Now, this idea isn't new. Gold has always been a hedge against inflation, but what makes this time different is just the scale of money creation we've seen post-COVID. Central banks have flooded the global economy with liquidity. This is the balance sheet of the Federal Reserve, and as you can see, trillions of dollars were printed and injected into the system in record time. And that's what's fueled a lot of the inflation we've seen. Sure, there were COVID supply shocks, but it's really the massive money printing that shook confidence in fiat currency. So naturally, during times like these, investors start looking for something outside that system, something with a limited supply, something that doesn't erode over time. And gold, with 5,000 odd years of trust behind it, fits that description perfectly. It may not earn cash flow as an investment, but in this context, it doesn't need to. Its job is to preserve value when paper money can't. And over the last few years, it's done that job exceptionally well. And that really leads us to the next reason why gold has skyrocketed, and this is a really big one. It is the growing concern around the US debt spiral. So right now, the US government is sitting on over $36 trillion in national debt, and that number is growing rapidly because of the ongoing deficit. So every second, the debt clock ticks higher. Every budget passed adds billions more, and this is really starting to concern investors. I mean, the US has lost its AAA rating from S&P and from Fitch, with both citing concern over America's ability to balance the books and repay their debts. And the problem isn't just the size of the debt, it's mainly the cost of carrying it. So thanks to higher interest rates, the interest payments alone on US debt are now over $1 trillion a year, which officially makes it one of the largest expenses in the federal budget. It's now bigger than defense spending. And just like a credit card that keeps growing, the longer that the US waits to properly address this, the more impossible it becomes to fix. But here's the kicker. How do you deal with debt like that? Well, governments really only have a few options. They raise taxes, which is unpopular and politically risky. They cut spending, again, not likely. We've seen Donald Trump do a 180 and agree on massive spending. And then there's the third option, the one that investors fear the most, which is inflating the debt away. It's kind of like looking back at someone who bought a house in the 1970s for, say, $25,000. Now we hear that and think, whoa, housing used to be so affordable back then. I could have paid that off in a year. But it wasn't that cheap at the time. The average salary in the 1970s was around $8,700. That mortgage still would have felt very painful, similar to how it feels today. It only feels small now because inflation has done its thing. Today we sit here with, a $70,000 salary and the median house price is over $400,000. So when we look back, that debt seems like nothing. Now governments think the same way. If they borrow trillions today and inflation drives up wages, prices, and tax revenues over time, then the real cost of that debt shrinks. They pay it back in devalued dollars. That's why gold investors are so nervous, because if inflation is the only realistic solution to this monster pile of debt, they don't want to be sitting in dollars that lose purchasing power. They want to be in something that holds its value no matter what the dollar does. So that's the second big reason why investors are flocking to gold and prices are so high at the current time. But then we get to the other reasons, external to the United States, as to why gold is going up so much at the current time. And this is really a big one in terms of the global economy. One of the core drivers of the gold price over the last few years has actually been other countries like China and Russia buying up massive amounts of this stuff as they look to reduce their dependence on US debt and the US dollar in general. For decades, US Treasury bonds were seen as the safest place to store wealth. If you're a central bank sitting on hundreds of billions in reserves, you just lent that money to the US government by buying treasuries and let the US government pay you a nice interest payment every year. That's just how it worked because it was perceived as such low risk. But that trust has started to erode. Why? Because countries like Russia and China have learned the hard way that the dollar isn't just a currency, it's also a geopolitical weapon. When Russia invaded Ukraine, the US and its allies froze hundreds of billions of dollars in Russian assets held overseas, most of it denominated in dollars. And that sent a message. If you end up on the wrong side of the West, your dollar-based wealth is not actually safe. And since then, we've seen a clear shift. Central banks around the world have started to reduce their reliance on US debt. Have a look at this chart. Look at the trend in Japanese and Chinese holdings of US treasuries over time. In 2020, China accounted for 15% of foreign holdings of US treasuries. But in December 2024, this percentage has shrunk to just 9%. They're clearly reducing exposure, as are other nations such as India and Brazil. And what are they replacing treasuries with? Well, gold, particularly in China, Russia, Turkey, and India. These countries have ramped up their gold purchases. In fact, over the past 3 years, central banks globally have added over 3,000 tons of gold to their reserves, some of the highest levels ever recorded. And as you can see by this chart from the Visual Capitalist, there are two main culprits. And this isn't just about sanctions either. China, for example, is dealing with deep cracks in its property market, an asset class that has traditionally been viewed as a safe haven for its wealthy citizens. As confidence in Chinese real estate falters, investors and institutions alike have turned to gold as a more reliable store of value. On top of that, both China and Russia are working to conduct more of their international trade outside the dollar system, sometimes even settling transactions in gold directly. So when you zoom out, the demand for gold isn't just coming from retail investors, it's being driven by entire nations rethinking what safe really means. And the more countries that move away from the dollar, the more demand shifts to something that has no allegiance, no politics, and no counterparty risk. And that something is gold. So when we look at the steep rise of the gold price over the last few years, that's what's really having the most effect. Massive buying by foreign nations to quite literally stuff their coffers with gold, as opposed to US government bonds. Now, in much the same vein, another major factor driving gold's surge is quite simply the rising geopolitical tension worldwide. Whether it's Russia's war with Ukraine, the ongoing conflict between Israel and Hamas, or growing concerns over a potential clash between China and Taiwan, the world feels a lot less stable than it did a few years ago. And in times like this, investors instinctively move towards assets that feel safe, and gold has always been one of them. It's like I just said, unlike stocks, currencies, or bonds, gold doesn't rely on governments, it doesn't rely on companies, it doesn't rely on peace to hold its value. It has no counterparty risk, no political allegiance, no CEO to mess something up. That's why whenever war breaks out or global tensions rise, we usually see a spike in the demand for gold. It's not because people think gold will go up, it's because they just want something real that they can trust if everything else starts to wobble. And right now, we're living through a moment where multiple regions are unstable at once, and the global order that underpins the financial system is starting to feel increasingly fragile. So they're the two geopolitical reasons behind the 2025 gold rush. And finally, the last piece of the puzzle is, of course, interest rates, and specifically the fact that they're now trending lower. So over the past couple of years, central banks around the world, especially the US Federal Reserve, have been raising rates to fight inflation. And for a while, that actually worked against gold. High interest rates meant investors could earn, decent returns holding cash or bonds, which made non-yielding assets like gold look less attractive. But now, the story is shifting. Inflation has cooled, the job market is weakening, and the Fed is signaling that rate cuts are on the table. And when interest rates fall, the opportunity cost of holding gold disappears. In fact, with real yields dropping, gold starts to look better than holding cash. Markets are already pricing in multiple rate cuts ahead, and gold is responding accordingly, because in a world where money is slowly getting cheaper again, investors want assets that can't be printed, can't be manipulated, and don't lose value when policy shifts, so gold fits that bill. And overall, they are the 5 forces working in gold's favor, which, because they're all happening at the same time, are kind of creating this perfect storm, causing the price to absolutely skyrocket. So overall, I hope you enjoyed the video. I do want to say a quick thanks again to investing.com for sponsoring this video. As a reminder, you can get 50% off in their sale at the moment, and then an additional 15% off using my code NEWMONEY at checkout. Also, a quick reminder for those wishing to come along to the 3-day live investing workshop in Atlanta with myself and Phil Town. We now have more people who have claimed a free ticket than what we have seats available, which means it's now a race. Basically, those who confirm their travel plans with the Rule 1 team will get those priority spots. So this is all sent in a follow-up email. So please, if you have not yet confirmed your flight or accommodation details with the Rule 1 team, please do so. That information should be in your inbox. I really don't want you guys to miss out, so please check that over. But with that said, I'll see you guys in the next video, and for some of you, I'll see you in September.